we had talked about this idea that you had some hedges on against your triple Qs position against the NASDAQ 100.
Yep.
Can you take us through what you did and why?
Yeah, leading up to the end of July, I was talking about looking at this summer doldrums. You know, we're going to go through this seasonality. So we got ahead of it. At the end of July, we raised cash. I've been on the show a couple of times talking about it. We raised about 10% cash netted. And so ultimately, when we did that, it was some of the big tech names we sliced off. I mean, we cut totally, like a Tesla and an AMD. But in doing that, it was netting 10% because we also added to Chevron, added to Pioneer, opened Amgen as a new position recently. You know, so others. So it's been a rotation that we've done, but there's still cash now. So now the market's kind of sold off. I'm looking at it as an opportunity to go shopping. But I want to be patient here. I think it's important to be patient in this environment because right now every rally is just getting slammed. It seems like a liquidity event. Every time this market rallies a bit, people are selling into it. And the way I looked at the QQQs as the puts as protection, last year we would do a 1 to 1.5% position sizing on puts. We were in a downtrend. I was looking to really cover the move to the downside. We're in an uptrend. This put position was more of a 40 basis put position.
And just to be clear, you basically own the Qs and then owned puts on the Qs.
No, we own the stocks. We own individual stocks.
But you then bought the puts on the Qs.
On the Qs, yes, because we did raise cash, but prior to the raising cash, we had a 50% position in tech. So we raised about 10% cash, call it 40%, 35% in tech still. That was my fear, is that if the market starts to sell off, it's going to be tech leading the way to the downside, some liquidity there. And having that as a cushion, the 40 basis point put position, is just a cushion to kind of digest this, because we're going to have inflation numbers, we're going to have jobs numbers. And as we look at these numbers that have come out, I mean, inflation is cooling, but it's supposed to cool. We couldn't rally yesterday or hold the rally yesterday. We rallied. The market ended up slamming down. I cut these puts earlier in the week because it did what I wanted. It cushioned this move here. So I think we can go through a bottoming process as the market kind of digests things. But it shows you how fickle the market is when you get a PPI number today that was still pretty hot. I mean, but the thing is about that PPI, the market reacted to that, but it couldn't hold the rally to a softer CPI. But the producers, these producer prices, who are the producers? They are the public companies, basically. So when this uptick, it was pretty much disinflationary up until today. Disinflationary means these margins for these companies are going to be squeezing lower. So this is actually, I think, good news to see a little bit of an uptick in PPI, while CPI is still sort of trending lower. And then we get Michigan consumer data today. I thought it was a terrific read. It came in at 3.3% as inflation expectations, and Fed Chair Powell has talked about it over and over and over again that inflation expectations are a self-fulfilling prophecy. If people think inflation is going to go higher, then it's going to rise.
All right, Kerry, and one more word to you before we kind of accelerate this conversation.